We got no food. We got no jobs. Our pets' heads are falling off. If that sounds like you, it may be because markets are down and you're down in your portfolio. But you know what? Today, we're going to help give some talking points on how you can do a couple of different things during times like this, right? Manage emotions, review and track your goals, asset allocation. And if none of that, then do nothing. But if you must do something, you may consider Roth conversions and or tax loss harvesting. So with that, boys, what we've been through a couple of these in our career, some more than others. What do you guys telling clients? What are some things you guys are doing on the front end to help when these market circumstances occur?
Well, actually, when clients call, I tell them exactly what you just did.
I like to panic with them just so that way we're on the same page.
And they usually reply with, "Oh, so we're fine. Yes, yeah, we're good."
That's empathy, right?
No, you got to be proactive. Educating clients on how markets work. Why do we always say things like keep it long term? Because these things are part of investing. You know, you're gonna have corrections, you're gonna have bear markets, you're gonna have recessions, and
wait, you can have good times too, though. Don't say all the bads.
And so proactive means working on your financial plan always, whether the market is up, the market is down, it's flat. Always looking at your situation, your objectives, and are you on track? And so that's the key thing.
I just like explaining to them, right, that these things are normal, right? And as much as it doesn't feel normal, it is normal. You know, we have these conversations about not having a crystal ball at the very first meeting as far as being able to tell you when these things are going to happen. All I can tell you is that they are going to happen. I think we should kind of give a stat, right? 3 years up, 1 year down. It's not always in that order. And so if you've done all these proactive conversations about, putting their assets where they need to be, looking at their emergency funds, make sure they have enough in case anything does happen, right? There's a plan in place. And it just makes it a lot more easy for clients because they've already kind of have a plan, right? They already have something in place. So they already know these things are normal. It's bound to happen. I kind of find it interesting now at the beginning, right? It used to be a little bit more of a panic. And now clients, I think, are conditioned to where they find it as opportunities. Yeah. So I think that's kind of the little change in the career, right? Where now it's not as, I'm getting a lot of calls of people wanting to put money into the market now. So.
A lot of conversation is, trying to make sure everyone stays cool and collective in these circumstances. And I think at the end of the day, most of the time, the client just wants to feel that they're still on track for the goals we've set. And we have so many tools and resources now, software that helps us to take a step back, review what the circumstances are, look at the goals we've implemented. Before these market circumstances occur, most of the software takes into account these types of drops, right? So reiterating to clients, hey, we've taken this type of drop into consideration when working on your retirement goals, working on whatever goals that they have in place, and having them understand that this is normal and what we've done in preparation for this time, we're still on track. We're still here to help them manage the emotional aspect of going through this type of thing. Because it's funny, man, I remember first starting in the industry, the account opening process with clients, we would do these risk tolerance questionnaires. Literally, I would sit down with the client and go through 10 questions to determine what the client's level and comfort of risk is. Now it's more dialogue with clients. You don't have to go through a full questionnaire. But one of the questions always on there was, how would you react if your portfolio was down 20%? And the clients in that setting, when their portfolio isn't down 20%, be like, no, I'd be cool. No, Barry, I wouldn't do anything. I'd consider investing more money. I'm
a long-term investor.
I'm a long-term investor. This is no big deal, right? And then it actually happens. They see the value of their account actually go down, and their thought process completely flips, right? And so providing facts, keeping them calm, helping them stay on track, providing some emotional support for them. That's a really big part of that process.
I like putting dollar amounts next to those percentages, though, so that way they kind of have an understanding. What does that actually mean? What does that actually look like in their portfolio, right? 10% of 100, right? That's only 10,000, right? But 10% of 1,000,000, that's a little different conversation sometimes with people. But yet, it's normal. 10% movements happen. That's very common. It shouldn't be out of the ordinary for people that have been invested long-term wise, right? They understand, they've gone through it. It doesn't feel normal right when it's happening. Doesn't feel normal when it happens really quickly, but it is normal over a long period of time.
I'm having issue with that N word. A pandemic's normal,
No.
but you just
I see what you're doing here.
The reasons for the downturn in the market may not be normal. I think what he's referencing is the actual declines in markets.
Yeah, I know
are
what he's
normal,
referencing,
right?
but our clients /
Right.
viewers might
Right.
not
Why
know.
the markets are happening and
call
what's
them
going
fans.
on.
Yeah.
That may not be normal, right?
Yeah.
You may be watching this right now and maybe 2050.
Yeah.
We're on Mars, but we lost a shuttle on the way over there.
You have no
Not
idea.
normal,
We might
right?
have filmed this in 1963. You have no idea.
No idea. No clue, right? But yeah, the reasons for why markets decline, what may be, all that is different. And that happens, different occurrences, different situations happen all the time. But the actual declines that occur and the frequency of them are very normal. And we plan for that. And that's the importance of what this discussion is our process and understanding comfort with risk, and then understanding time horizon for what the client's trying to achieve with their goals. Utilizing that along with the software and the capabilities that we have, we're taking into account these market declines over time, and whether that affects or does not affect the goal that the client has in place.
So I know y'all are financial planners, but a great philosopher. You know what a great philosopher once said about plans?
Mike Tyson?
He's one of my faves.
Yeah. That everybody's got a plan until they get hit in the mouth, right? So that's great. We're proactive. We do all that, but something changes when your pet's heads are falling off, and kind of panic sets in.
Definitely.
So, what are some ways to not panic? Some things to remind ourselves. Like, what do y'all do?
Yeah, for me, with my clients, it does really help to talk about the environment, so at least they know you're kind of on top of things and you're aware. And then even though most clients know that philosophy-wise, I don't think you can predict markets. They still want to know your opinions and what your thought process are, but at some point, you got to bring it down to their situation, specific to them. And I think that's how I think helps them when you break it down in terms of, hey, just a reminder, we've got 6 to 12 months of expenses in your emergency fund. We're on track for your kids' education. We have life insurance in case something happens, and we're not, and then we're still on track for your retirement goals. And I think that's what really helps them when they know, okay, my portfolio's down. And for some clients that are a little bit more analytical, they do want to hear some of those statistics, like how often do the corrections happen, how often do bear markets happen, what are those things, and what to expect. So I think more information and just bringing it down to their specific situation is what really, I think, helps clients.
I think what can you control, right? What can you do in these situations? Kind of going back to what Leo was talking about, right? You can look at your asset allocation, you can rebalance your accounts, you can look at doing Roth conversions, do some tax harboring. So just kind of giving them, kind of to what James was saying, giving them a rundown of what options that they can do, what they should do. A lot of times, right, they just want to know that, right, that you've thought about their situation, you've thought about how this impacts them, how this affects them, and knowing that, right, that there are different options that they can at least take some sort of advantage of these situations.
Yes. So what I would say is, to your point, I think sometimes not even my own clients know. We've talked about it,
Right.
but they forget that we have 6 to 12 months of living expenses put away in cash.
Yep.
That we don't have to sell anything while it's down.
Right.
So I find it helpful to remind them of that. So if you're doing it on your own, check your cash reserves, see how much you have set aside, make sure it's enough. That could help you manage your emotions.
Yeah, like for retired clients, same concept, just reminding them, hey, we're using a bucket strategy. So we have at least a year to 2 years of withdrawals put into whether it's money markets or CDs. So when the markets are down, we're not having to withdraw from those investments. We're withdrawing it from your more conservative investments that are not down, allowing those investments to recover. And it gives your probability of success or being able to stay retired, up, at a high probability.
Yeah, and this might be on the proactive side, so doesn't really necessarily have that concept doesn't apply to just retirees.
Right.
There's a reason why we say, hey, if you have a short-term spending goal, like in the next 3 years or so, you probably shouldn't be invested in stocks. So if your financial advisor is more than likely not invested that, so hopefully you're still on track to meet your goal, even during a downturn.
Yeah.
Yeah. We always have the recommendation, especially for emergency purposes as well too, determining what total expenses are on a monthly basis, and then having some type of short-term instrument to utilize for that emergency purpose. But having that in the back of their mind, that gives them an understanding of, okay, then we can fulfill any short-term income needs and allow some time for markets to recover, which historically speaking, they always do.
Right.
Right. It's just a matter of time. Yeah. Right. And so are you in the appropriate situation where where you can practice patience and allow markets to recover without having to, liquidate something that would be at a lower valuation if not necessary.
Yeah, and every client is so different, and you just have to keep that at top of mind, because you'll have a client, they'll just call, hey James, are we still good? Stick to the plan? Yeah, cool.
Yeah.
All right.
Yeah.
And then you'll have another client, hey, show me.
Yeah.
And so that's where software does come in, because financial planning software, you can run stress tests that can show if they're still on track. You can there's Monte Carlo simulations where you're running hundreds, if not thousands, of different market environments and see, are you still going to be able to reach your goals based on those different environments? You can run a stress test. What if inflation is higher than usual? What if your expenses are higher? And see, are you still on track? And then if you're not on track, this is where you get to be proactive. What do you want to do? Do you want to increase your savings? Do you want to work a little bit longer? You want to reduce your expenses? What's feasible? And so that's the real keys to being proactive and understanding the client and what's actually doable.
Right. Yeah, I think running through those scenarios and those illustrations, one thing that is typically done is an average rate of return in retirement. And situations like what the audience may be dealing with right now, and you have plans to retire next month.
Yeah.
And your 401k, even if the allocation is 50-50, 50% of your portfolio is down, currently right now. Well, we'll get into allocation discussion, but that's the importance of having a portion of your portfolio not directly impacted by U.S. equities right now, because when we're running those models, they're taking an average rate of return expected over the course of a certain period of time, but not taking into account that first year you're retiring, maybe that down year, that's down 15%, and now we're taking distributions, which that will snowball as far as expected total asset value throughout retirement, right? And so the importance of asset allocation is something we can get into, but that's such a big piece of this, because giving the time to allow the equity portion of your portfolio to recover, and if your entire portfolio or a large portion of your portfolio is equities, and now you're taking distributions, and it's down 15% or 20%, that changes the complete trajectory of the total value in your distribution strategy in retirement.
How is this supposed to help me manage the volatility I'm currently going through?
Well, asset allocation, right?
Okay.
And we were discussing that and mentioned that earlier, right? The importance of reviewing that regularly. So we talked about going through some type of risk tolerance and understanding your comfort with risk based upon the types of investments that you would have inside your portfolio, right? For us, diversification is such a key thing to help us manage risk. And we want to make sure that there two things. We diversify with asset classes. We diversify with sectors. We diversify with duration. We diversify with many different investment vehicles. But the importance is that we're spreading out risk and looking at your portfolio and understanding how that risk is spread out. There's not too much overlap in your portfolio, that you're taking on more risk than you thought you were taking on. That's one of the things we had looked at when we were looking and reviewing at portfolio construction. A lot of the funds we were utilizing, when you get into the actual makeup of the fund and what the portfolio manager is actually investing in, the fund may say that, hey, this is a U.S. value fund, yet inside that U.S. value fund, they're investing in high growth stock, and you have a high growth stock in your high growth stock fund in your portfolio. So the expectation as you know, the individual constructing the portfolio is, I'm diversifying. I'm diversifying with something that has value. I'm diversifying with something that has, upside growth potential. And then you get down, you start to realize, there's overlap actually.
Right.
And this fund is actually investing in some of the same stuff I'm already investing in. That means you're taking on way too much risk. And when you go through times like you may be going through right now, a certain asset class may be underperforming significantly, and you're over allocated in that asset class.
Yeah, go ahead, Jim. Sorry.
So I know we've tricked y'all because we've veiled it so well, but we're currently going through a down market right now. You just don't know which one, so we got you. However, current conversations that people are worried about the current economic environment, I find it helpful to remind them of what they're currently invested in, because they often think, stock market's down, I'm going to lose everything. So I like to remind them that they're not 100% invested in stocks. Right? You have, so right now currently, it may only be the U.S. stock market that's being impacted. International may be up, and bonds may be up. So those things are holding up the portfolio a little bit. So I find it helpful to review your asset allocation whenever you're going through it. It could be a nice reminder that, hey, I have 2 to 3% in precious metals, and precious metals are at an all-time high. Whenever I share that with a person's portfolio, because most of the time they don't even know what they're invested in. Right. I just see it like
a relief. Yeah, having that conversation with their entire portfolio does not look like the S&P index, or does not look like the Dow Jones or the NASDAQ, that they're much more diversified than just those 3 positions, changes that conversation. It normally brings them a little bit more comfort of them knowing, hey, we're not getting beaten up as bad as those indexes. Sometimes even spreading out that time frame, right? Having them look at not just year to date, but just what they've done over the last year, 3 years, 5 years, showing how much growth or returns they've had. Sometimes that helps them at ease. If you've gotten into the situation of having that asset allocation, right? Instead of having CDs in non-retirement accounts, having those in retirement accounts, having stocks in their non-retirement accounts, when you do have these type of downturns, at least we could take advantage of some tax harboring, compared to if it's all in retirement accounts, it's all sheltered, so you can't really take advantage of some of this market volatility. So I think figuring out all those little nuances for people are huge and have huge impacts even in these volatile times.
Yeah, the diversification, just showing and reminding them but even when you just click one of the funds and showing them how many holdings one fund has, because clients will look at the bottom line, right? Am I up or am I down? And then you mention, hey, you have different asset classes, but then you just pick one fund and show them this one fund has hundreds of investments. Oh, okay, I didn't know that. Yeah, and those kind of little things that do help them. So.
You mentioned tax loss harvesting a couple times. So maybe we go there now.
Yeah.
I put this under the category of, all right, so we started off with, what should you do in times of market distress? Nothing. You should do nothing. But and what I mean by that is, some people think, right, like, hey, should we get out of stocks, go to cash? No, do nothing. Do not change your asset allocation during times of market distress. Review your asset allocation to remind yourself, but don't change it. But if you must do something, I would argue right now would be a good time to convert from a traditional IRA to Roth IRA and to harvest losses.
Yeah.
What are those concepts? What does that look like?
I never have losses.
Yeah, I have no idea.
You know what? I'm glad you said that because some people will say like,
Yeah.
why would I want to do that?
Yeah.
Yeah.
I know that conversation is tough for some practitioners, and that's why I kind of mentioned that, because you are literally mentioning to your client that you have losses.
Yeah.
And that's where you have to, understand your philosophies and your belief systems, and that you have a diversified portfolio. And what that means is not everything is going to move in the same direction. And that's actually how you know that diversification is working. And then we can take advantage of it from a tax perspective, where we can purposely sell an investment at a loss, which can help offset your taxable income. And we like to do it proactively, because there's different rules of thumb when tax loss harvesting, like wait until the end of the year. Well, what if there are no losses left at the end of the year? Yeah. So
December is a typically pretty good month too. So
yeah.
Well, it's always interesting,
Santa
right?
rally?
Santa rally.
Hey, sign up for that one.
You've been signed up.
I've been a good boy. Hey, what were you saying?
It's always interesting, right? When you can show somebody that their account's actually higher in value, but yet they have a bunch of losses in their account.
Yeah.
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 You know, I think the nice thing with some of the different instruments that are out there is in some cases, it's very easy for you to get out of an S&P index position, sell it at a loss, and jump right back into it using a different company or a different investment that's almost exactly the same, but yet you get a chance to basically recognize the loss and not have to lose out on being in those positions.
Why do you have to do that? Why can't you get back into the same fund?
Yeah, there's some rules to it. It's called a wash rule, right? You got to wait 31 days. So, right, if you sell a particular stock, you need to wait 31 days before you buy it again. Otherwise, your cost basis gets aggregated.
Just the stock or?
Stock, I believe mutual fund, I believe electronic traded fund.
The key in that situation, and this is the thing I remind clients, because we, in this environment that we're currently in, we're doing this quite a bit. And you're right. Like the client hates, like the idea is like, why would we sell? We're down. This is a terrible time to do that. Yeah. Well, the idea is to get into another investment of similar investment style, asset class, something very similar, or another opportunity that you feel like may be able to provide, long-term opportunity based on where the valuation is, and capture that loss at that time. And so whatever that short-term, long-term capital losses, they offset each other. You can take a long-term capital loss and offset long-term capital gains, right? So this is a good scenario where if you have someone has an investment property this year, right, and they have a capital gain from that investment property, taking capital losses from the equity portfolio will help them offset some of the capital gains from that real estate sale that they have. If you don't have capital gains for that year, then you can offset $3,000 of taxable ordinary income for this current tax year as well too. So in doing so, I always reiterate to the client, hey, we're not just selling it and then doing nothing. Like typically we're trying to get a very similar or like investment, and looking for another opportunity with that cash.
Yeah, and you can carry that loss forward too. Yep. And I think that's worth mentioning, because in future years you might not have any losses.
Right.
But at least you have some carryover from previous years.
Yeah, some clients I have carryovers from significant carryovers from a couple of years back.
From another advisor, right? Not you.
Not me. No way.
All right. Speaking of other advisors, I gotta ask you this. All right, so because I got asked this one, I had never been asked this before. Okay.
I take a step back. Wait a second.
And I'm gonna change the example. So
all right.
Yeah.
Ooh.
Yeah.
Okay.
Yeah.
Curveball.
Some other advisor. Three. We'll say, for example, 3 intermediate term treasury bond funds. Have 3 of them.
Oh.
All of them are at a loss, you recommend, being a great financial advisor that you are, to harvest tax losses. You say, you know what, let's get rid of these two and buy that third one. Why would I want to buy an underperformer?
Because it could overperform. No, I mean, it depends, right?
Buy low, sell high.
Okay. What else? Oh, you're looking at me with a blank stare.
I'm trying to figure this one out.
Okay, I'll give you the answer.
It's a trick question.
No, it's not. No, it's not.
That's what he's thinking.
Because I think... Because
We're in sync. This is a team,
we finish each other's...
except for right now.
Sandwiches.
Yes. I think people think, all right, tax loss harvesting, you're getting rid of an underperformer, right? Well, no, that's not why we're doing it. We still like the fund. We just can't rebuy it because it's a wash sale. So we need to buy something else. Well, why would you buy something that's down? Well, because your asset allocation calls for that asset class, and the entire asset class is down.
Right.
Just some down a little bit more than another. So I think that's important for people to understand.
Yeah, we've gone through years where everything is down.
Yeah.
There is no positive performing asset class. So where are you going to move to? If we're going to take advantage of the circumstances, right? And we're going to take a tax loss. We're going to move to something that's probably at a loss as well too, because every asset class is down no matter what.
Well, based on long-term performances, more than likely you would go to equities then.
Yeah.
If you're having to
probability.
rebalance.
Yeah, the probability is that, right?
And
But
that's
taking
why-
in consideration risk as well, like we were discussing, right?
That's why he kind of mentioned at the beginning, don't do anything when your investments are down, because if you do go to a more conservative strategy, it's going to take longer to recoup your losses.
Well, I find that interesting, right? When it's down, right? That's when people want to do all these crazy things. So, right, it goes back to that. So you want me to sell at the low,
Right.
and then you want to buy back into it once it's gone back up in the high. I always tell our whole objective is buy low, sell high, right? Opposite, and yet they have a hard time with that sometimes.
And you got to remind people, like, if you're down 10%, we're going to need 11% to break even. Or if you're down 20, you're going to need 25% to break even. So if we go more conservative, our rate of return is going to be lower. It's going to take longer. And the answer might still be, that's fine, James. I still want to do it. I'm still on track. But at least they're aware of what the ramifications might be by doing that right now when investments are down. So, but at least they know their options. Yeah.
James, I lost 30 grand today.
Yeah, I like those questions or statements, because everything is so relative. Yeah. So you have to bring it back to, based on the size of your portfolio. Did you know you're only down this percentage? It's like, oh, okay, the dollar amount. And it's kind of interesting, because as you're helping your clients reach their objectives, it means that they're going to have more and more wealth.
Yeah.
And the more and more wealth that they have, the dollar movements are getting bigger, even though the percentages are the same. So you actually have to do some behavioral finance with them and just remind them, hey, you've been very consistent in saving. You're on track for your objectives. Your accounts are getting bigger, and the movements are getting bigger. But I just want to remind you, the percentages are the same.
Yeah, just to be clear, to go back to what you were saying earlier, piggyback on both y'all.
Yeah.
Okay, on average, the market dips about 3.5 or 3 times a year, and a dip is about 5% drawdown. It corrects once a year; it's about 10%. And then there's a bear market, which is 20% decline once every 3.5 years. What I'd like to remind people is that, so a $2 million portfolio, $2 million you have saved up, a 10% correction is $200,000. That is normal.
I love that word in these situations.
But it's a regular occurrence. The cost for it might be different, but it's expected.
Yes.
That if you have $2 million in equities, that will fall by $200K in a year.
Yeah.
I could have paid off my house. That one recently. That's how much I lost, James. I could have paid off my house.
Yeah. I love the calls in the days when the account is up $30,000. Oh wait, that was never happened. A call when it's like,
You know that's your fault, right?
oh, I know.
You know, I just got done telling you, hey, you made this much today. That's what you do. It's a proactive.
You got to be proactive. with it, yeah. But they're proactive when it's down. There is no proactiveness when it's up, which is fun. I mean, understandable, and it's managing. There's a higher degree of emotion when it comes to down markets.
I just think there's so much information that's out there, right? Through media, through social media, it's being blasted in their faces a lot more. And so there's a heightened sense of fear that's being instilled to them just because of the information and how they're receiving it. And so I think having that conversation with them about how does this actually apply to you can sometimes bring that to somewhat of an ease for them.
Yeah. Why y'all glossing over my Roth conversion
Oh
comment?
no, I love it.
Oh, that was the back of my mind the whole time.
Yeah. It's
Well,
actually
let's bring
right
it to
at
the front. Yeah, let's bring it to the
tongue.
front of the mind right now. No?
Yeah.
So what's up?
Roth convert. I mean, this is a fantastic time to implement a strategy like that. And reason being is because of the tax treatment of the assets in Roth accounts in comparison to traditional IRAs. And so in a traditional IRA, right, the tax liability is deferred. So the accounts are growing, and while that's happening, your tax liability is continuing to grow as well too. In this situation, while markets are down, this is a fantastic time to do a conversion where you are taking assets where you have a tax liability, paying that tax liability, now selling at a lower value, and now moving that asset into a tax-free account. And now what you're doing is you're now moving the assets into an account that has the opportunity to grow, market recovery time frame moving from here on out, and now it's going to be growing at tax-free tax benefit, which it's huge. It's significant when you start to look at the impact over time of not just the appreciation of the asset, but the tax implications and tax liability over time as well. So you mentioned it, right? Do nothing if you can't, right? If you're one of those people that can't sit on your hands during this time frame, tax loss harvesting and the Roth conversion strategies are extremely beneficial in comparison to flatter up markets.
Yeah. My name's James Riquez. I'm a financial advisor, and I like numbers. That was a confession there. So I find it helpful to use numbers. So let's say you have a $50,000 traditional IRA that you were kind of like, hey, I heard about this Roth conversion. I'm thinking about doing that. I should do that. Now your $50,000 traditional IRA is $40,000. Convert that at $40,000. So you only pay taxes on 40 instead of 50. And then hopefully it recovers because it always has so far as of the filming of this. And let it recover tax-free in a Roth IRA.
Yeah.
Rules are that you do need to wait 5 years, right? After you've done the conversion, right? After you've done a conversion from a tradition to a Roth, right?
Like it.
Yeah. So right, there are some nuances behind it, right? So we got to wait 5 years before the distributions actually come out tax free.
Yeah. And let me rephrase that then. For qualified Roth IRA distributions.
Right, exactly.
Cover all. Let them Google what the qualifications are.
Yeah. The conversion strategy, obviously, we want to run that through software, right? Because when you do that conversion, that is considered income for that year. So it's really important to understand, yes, is a really good time to do a conversion, but is that conversion worth what you may end up having to pay tax-wise by taking on that income because of that conversion? Right.
Yeah, don't just do a Roth conversion because it's down.
It's down. Let's convert it.
It's got to fit into your plan. If it was already in the back of your mind, or you know what? Even this came up the other day too. If you were considering making a Roth IRA contribution, you're just never getting around to it. Like right now might be the time to do it because you buy low, sell high, right?
Yep.
What do you say to clients, James or Leo, Alexis, after I do the conversion, and let's say it's you're converting cash? Do I invest the whole thing right now, given this market environment, or do I go in over time? What do you say to those clients? Lump sum or
DCA? Is that
DCA?
Yeah, I mean, I think there's been some more evidence now at the time of recording that the DCA strategy doesn't equate from a growth perspective to the same as if you just did the full investment at once. So I've gone away a little bit more from that. You know, I think markets are down, right? If we have an asset allocation, we're going to get the portfolio invested appropriately to what the asset allocation is now. Trying to DCA and hoping that we're going to get it and our total cost basis will decrease over time. And I mean, I think if you have the cash now, we know markets are down. We have an asset allocation. Let's just get the cash in.
I think doing the DCA thing is harder in practice, right? I think it's a good concept in theory. It's harder in practice. And so if there is something like that, that's only going to be done for somebody that just can't stomach the volatility maybe at this point in time, but that's more of a one-off scenario, right? You're really trying to push them back towards and getting them invested, right? They were already invested for the most part. Now that the market's changed, right, there isn't any reason for them to start changing their investment philosophies now, right? Just because the market's volatile.
I think some might say it's time in the markets versus timing the markets is what's key. So for long-term performance.
It goes back to that crystal ball, right? You don't have it. None of us do.
Yeah, you know what? I don't even think we mentioned the most obvious things about the way to get through this. Don't time the market, resist the urge.
Right.
You can't time the market. And if you're buy low, if you can't bring yourself to do that, at least dollar cost average, systematically invest a specific dollar amount over a specific period of time to take advantage of the ups and downs. Yeah, you might underperform just putting it in lump sum, but if you can't bring yourself to
it's more of an emotional thing.
Do it, Captain.
It's behavioral.
I can't
Behavioral thing.
do it, Captain.
I get it though.
I think it feels
better.
It feels better.
It does.
Yeah.
It does. I think another thing to consider too is especially we get calls, and right now there are some clients that are conditioned, right? Understanding what these circumstances mean and looking at it from an opportunistic aspect. I think understanding what you're investing in with equities is really important right now as well too, because there's a reason why you're going through this specific market correction, whatever that reason may be. And it may, I mean, historically speaking, there have been businesses and corporations, large corporations that have gone, completely away because of certain circumstances happening. So I think it's understanding what you're investing in and the quality of what you're investing in as well too. I mean, if you want to take a chance at that, real, small cap company that is down 80 something % right now, understanding the risk of doing that, but also understanding that, hey, if you just want to start buying in because markets are down, do so with quality and understanding the quality of those investments as well.
Don't look at me. That's all I had.
Recap.
Well, we could recap or
Keep going.
I mean, no, just I had an aha moment.
Oh.
Yeah. Y'all said your clients are conditioned. You're not getting a bunch of calls. Then why are we making this podcast? If our clients already know, why are we making this podcast?
Because everybody's not our client.
Ooh.
Tell us more, Leo.
Preach.
Well, I think
So to that point, right? So are you saying these strategies? Are you saying people should be watching because these strategies led to your client? Yeah.
Exactly. No.
So these aren't like hypotheticals or stuff you read in a book. Like this is your real world experience. This is how this is how you've gotten through these things, and this is how these are.
Yeah, and to be frank, we've had such a large increase in retail investors, really over the past 5-ish years too. We've seen that market grow, and these are individuals that are doing it themselves. A lot of individuals doing it themselves, and may or may not have gone through some type of correction time frame, but if so, probably have done incorrect actions during those time frames, or not understood opportunities in regards to some of the strategies we've already discussed, and so. Yes, these are individuals. This is really pertaining to individuals that haven't been conditioned to deal with these types of circumstances and these types of conditions. And if you go by the playbook, hey,
yeah. Like, look, this is not a promotional plug or like
Click here
self-interest.
to our website. Just
That's
kidding.
no, I mean,
Yeah.
but again, I had an aha moment because this literally happened recently. One of my clients was telling me that people they knew were freaking out. She wasn't, or he, or you don't know who I'm talking about. They were not freaking out, but their friends were. So to me, that told me, well, because you have a financial advisor, we've spoken. I know your goals. We have cash set aside. You have an emergency fund. You're properly diversified. We've talked about this before it happened. We've been through a downturn. It ended up okay. And these other people they're referring to are older than me, so they presumably been through several of these things. But they're not okay.
Right.
They're freaking out.
Right.
So what I would say is consider talking to a financial advisor. Okay. Hopefully it's us. If it's not, that's okay. But talk to a financial advisor, especially before you decide to do something crazy like
Right.
get out. Because that's the other. I don't know. I've heard people say like, look, if it gets to this dollar amount, I am getting out. And to me, that's the worst thing you want to do.
You know what? Yeah, you just reminded me. I was talking to a client earlier this week, and I think they were mentioning, I don't know if it was a friend or a sister, but they were panicking so much. They sold their investments inside their IRA, but they thought, and they wanted to go to a CD, but they thought they had to withdraw the money from the IRA to go into a CD. Versus just, you sold your investments, probably not the best thing to do, but you can still buy a CD inside that IRA. But if you don't have someone that can give you that guidance, that someone that can tell you, hey, I know you're panicking and this is your monies and this is what you want to do. You can do it, but you can still buy a CD inside the IRA. You don't have to withdraw the monies outside where it's taxable. So
I think it goes back to, right? Yeah. Some of them don't have a plan. A lot of times they know what their account value is. They don't actually know what the investments that they actually own, especially if they're convoluted in a mutual fund or ETF. They don't know what's actually inside of there, right? They just picked the one that was the best performer last year, right? So that's the one that's going to do good again this year. And so I think having that understanding of, for our clients, right, they have a understanding that, right, we know what's inside of there. They're relying on us for that information. If you're doing it yourself, right, do the due diligence of actually knowing what you own, have some sort of plan in place, and obviously, right, don't panic, right, when things happen. These things are normal. Don't start selling everything because the market's telling you to do that, right, or the news is telling you to do that.
Go with that N word again.
I've been telling no comment on that.
With 401ks, because a lot of individuals participate in their 401k, the target date funds inside the plans actually do a good job of helping with this issue, because what those funds do is they adjust the asset allocation the closer they get to the date of that specific fund. So if you're participating in your 401k and you're not changing the asset allocation ever, and a lot of people do that, right? They're just putting money into it, investing it. Hey, I'm doing the match. I'm just putting money into it, whatever it's investment. I don't know. I'm not looking at it. I just do what I need to do. That target date fund, it provides a huge benefit for you in the sense that it's automatically taking the asset allocation and making it more conservative the closer to that date. And that date typically pertains to a retirement date. So you don't have to worry about, oh man, am I over allocated in equities, or do I not have enough? Well, strategy wise, you need to become more conservative closer to the need of that income. And so utilizing something like that, performance wise, is a different conversation with some of those funds, but from a risk perspective and for the time in which you may need the funds, it works really well to be able to help assist that if you're not working with a financial professional.
That makes me want to think of like that time where people are panicking, right? Because the market's down and they're 35, 40 years old. It's like, are you retiring today? Or how, are you when are you retiring, right? And it's typically further down the road. And so you're complaining about everything being on sale today, right? Everything's on discount. Everything's been reduced in value, and it's cheaper to buy it now, right? So you thought it was a great buy yesterday. Now it's 20% down today, and now you don't want to buy it. I mean, most of the time, if I told my wife comes to me all the time, right? I got this purse on sale, right? That's 20% off. It's never a sale for me, right? So it's money going out, but nonetheless,
unless your wife.
she saved us money.
Yes, she did.
Saved us money. Yeah. And then when
I
she
roll.
returns it, she made you money. When it goes back, and she gets money back for, oh, babe, we made money.
Hey, you mentioned 401k, so it just reminded me too. Workplace employees.
Yeah.
If you're not quite ready to talk to a financial professional, be careful who you're asking at the workplace, because I've seen situations where an employee is near or at retirement, but they're not ready to ask a financial professional. So they ask a coworker who's more savvy with the 401k website. And let's say that employee is younger. And I've seen it where the younger employee recommends something very aggressive because they have a longer time frame. They mean well to their employee that's about to retire.
Right.
So at the very least, every 401k plan does have financial professionals that you can call. If you're not quite ready to work with one locally, face to face, at least call those professionals. It's always good to ask for help, but just know who you're asking, because their situation is completely different from yours.
Yeah, and I gotta state this because I'm shocked that you're freaking out,
Yeah.
and I'm here to help you, and you still don't want to talk.
Right.
So what I would say is no cost, no obligation. We're really here to help. Please reach out if you're panicking, because I've actually heard. I hate saying about what keeps you up at night. I hate that saying, but this really does keep some people up.
Yeah.
And so if you're at that point, please reach out. No cost, no obligation.
Breaking out in hives, losing RAM. Yeah. Can't do that.
Losing REM. Yeah, that's a whole nother. Okay.
Yeah.
So so tape your pets' heads together,
Number one.
right?
Pretty bird.
Stand still.
Yeah. So okay, manage your emotions, review your asset allocation, review your progress towards your financial goals. Consider a Roth conversion if it's within your plan. Harvest some losses. Stay the course. Reach out to a financial professional.
Yep.
Thanks for tuning in. That's our 2 cents on your dollars.
Peace out.